Hello, everybody. I'm Mike Greenlay. Welcome to our Tradition Going Vertical podcast. As usual, my co-host is Erik Hendrikson, president of Tradition Mortgage, and our special guest today is Cory Carlson. He's an investment advisor with Tradition Wealth Management. Welcome, both of you. And just to start off real quick here, Cory, tell us a little bit about what you do with Tradition Wealth Management.
Thanks, Mike. So, wealth management, we are basically helping individuals, families, companies with essentially everything kind of in the financial world, outside of drafting legal documents and writing up taxes. Everything other than that, we kind of try and help shed light on, whether it's the investment world, planning for different goals, planning for retirement, 401ks, all that. You name it. That's kind of what we're here to help shed a light on, or at least provide a resource for. And so, it's certainly been an interesting one with 2022, that is for sure.
Anybody associated with the financial markets at all is raising their eyebrows all year long. And one guy who's raised his eyebrows a lot, Erik Hendrikson. Yeah, I know it's been a tumultuous year. Kind of give us a quick little synopsis on the mortgage side of things from 2022.
Yeah, really not much went on. Boring.
Yeah. Ho-hum, right?
Other than the fastest rate increase since they've been tracking interest rates. So that was tough. I would say, my recap of 2022, the best thing about 2022 is that it's over. But overall, honestly, a lot of good things. I mean, it is a very healthy housing market from a standpoint of demand, obviously, and values not rapidly decreasing. I think that with an interest rate rise like we've seen, that would be the fear. But again, just such lack of inventory has kind of buttressed us against that. So that's certainly a good thing. But really, the huge thing that really rocked us was just the kind of about face of the Federal Reserve and really just inflation. Inflation is what drives interest rates really in the end. Mortgage rates, as we've talked about in prior podcasts, are driven by the bond market. Fannie Mae conventional mortgages get bundled up and put into pools and sold as bonds, and they're traded on the bond market just like U.S. Treasury bonds. So inflation eats at that return. So if that inflation is running wild, anybody that wants to buy a bond or a mortgage is going to demand a higher rate. So the Federal Reserve, a lot of us in the mortgage world felt somewhat betrayed by the Federal Reserve as we saw inflation going up, certainly coming out of COVID with supply chain disruptions and kind of pent up demand for a lot of consumer goods and services as people were kind of coming out back to life. We saw inflation going up, and the Federal Reserve use this word transitory. I don't know how many times they said that, but they're like, basically pay no mind to this inflation. It's all going to take care of itself as supply chains even out. And then they kind of came out with the hammer early, kind of towards the end of Q1 of last year and said, well, nope, this inflation's for real. We're going to have to hammer interest rates. We're going to have to, slow everything down, and we're going to transition from our easy money policies where they were buying up treasury bonds and mortgage-backed securities to depressed rates to the point where they were then selling them. So not only are they not helping subsidize rates, they're actually doing the reverse. So that was a tough portrayal, and that's where you saw that huge spike, and that's what really, where you saw the housing market and the new construction market really kind of really hit the brakes. By kind of midsummer there, that was kind of the full transition. Even in the fall, we saw rates kind of top out, 30-year fixed conventional rates at just a little over 7, which was amazing. For those of us that have been in the business for close to 30 years, we've seen 7 a few times, but it's been a long time since we've seen 7. And that was kind of a shock to everybody's system. So just sent people scrambling around. But since that time, we have come down. We're now kind of in the low 6s in general, so that's a big improvement. So we're hopeful heading into the new year, but man, what a shock. Just massive interest rate shock that we haven't seen in decades.
Cory, given the landscape, your clients are going to want different things, and in a certain market, they're going to want these elements, and in another one, they're going to want other things. What have you noticed that, from your client pool, what have you noticed has been very popular right now with what you guys have to do?
That brings in perfectly, like Erik said, with the Fed and the beginning of the year, and you hear transitory and all these things, that when there was such kind of a misconception at the beginning of the year, they're certainly not going to slow these things down until they know this is for sure tampered. Because if they already seem to somewhat maybe guess wrong in the beginning of the year, they're certainly not going to do probably turn this around until this is completely tampered out as far as the inflation goes, which brings a lot of new opportunities. And there's just different things, whether it be money markets or treasury rates. One thing with those treasuries that kind of go hand in hand with the mortgage rates is, seeing those at a 6 or a 9 month at north of 4% is certainly something that we haven't seen in a while, and so that has brought on can be an interesting thing for clients. So it's finding these pockets where, whether it be structured investments where you can hedge some of the downside risk, with some of the options and capturing the upside, or the treasuries and some of this fixed income stuff that just is yielding now more than what we've seen. It's certainly trying to find the things that these rate environments are going to offer for us.
Speaking of opportunities that come with the higher rates, certainly those of us in the mortgage lending industry, aren't excited about it. But so they always say, like, in a high interest environment, it rewards savers versus borrowers. And we went through, basically a decade and a half of an ultra low interest rate environment. So it was a fantastic environment if you're a borrower or a lender like us, that sell mortgages and bundle them up and sell them to Fannie Mae. So that's great. But again, if you're, a little bit older or more conservative, you really didn't have a lot of options for a long, long time without, stepping out to a higher risk element, with equities or stocks or whatnot. But basically, the U.S. government, it's kind of the closest thing to kind of risk-free investing you can have, and to be able to do a 2-year treasury and be in the mid-4s is, again, a pretty amazing opportunity. And that has created some challenges too. We've seen where, like on our banking side, typically, we lend out our deposits, but we need deposits to make loans, and we've had a real strong loan demand, both personal and commercial. And if all of a sudden our clients that are sitting on large deposits in our bank decide that they want to go buy treasuries, we lose those deposits, that liquidity, if you will. So that, we're kind of starting to see that in the banking industry now. In this higher rate environment, it poses challenges from a bank standpoint, because that's their that's their dry powder to make loans, are these deposits. But it kind of plays into what the Fed wants to do. They, banks kind of serve as a amplifier of money, to create that velocity out there. And if banks do not have the liquidity to make loans, they can't lend to businesses that are then investing in infrastructure improvements or inventory or other things. So it kind of slows everything down. So seeing all this unfold makes me very hopeful that the rates are going to come back down. And to me, the harder the Fed goes, and if they do further bumps, the faster it's going to come back down, because it's going to create some major headwinds that are already at play. So to me, for those people that are looking for fixed income or other opportunities to lock into them now or in the next quarter, those will be good opportunities, because I think they're going to go away, and we'll get to a little more of a normalized environment in 2023.
Cory, what's normal for wealth management? Obviously, you guys are always dealing with one thing or another, whether it's whether rates are one way or the other. You always are dealing with some element. But what's going to be kind of normalized for you guys, even if it's something that you haven't seen in a while?
Kind of what past history has showed us in general is, with the stock market, it tends to build in kind of the worst case scenario, as fast as possible, right? So throughout this whole year, as different, whether it was Powell talking about what the environment or what the plan was as far as the rate increases, the stock market tries to get as far ahead as possible of that and say, okay, what are we, in our terms, it's kind of what are we baking in? What's the stock market already baked in? So as soon as, kind of like Erik is saying, as soon as what we're kind of looking for as 2023 comes around is with the rate environment. So as soon as we see those things, start to ease, or as a landscape of, going forward, that these things may start to, be a little more dovish, as the Fed speak would say. I think the stock market will really react to that as well. So just trying to get ahead of these things, and that's kind of where the stock market typically goes. Another thing that we will be watching is, 2021, your main stocks that are kind of tend to carry the market, your Apple, Amazon, Microsoft, Netflix, Google. 2021, those really carried the market for a lion's share on the way up. Well, it's just been the opposite here in 2022, where, if you look at the market without excluding those, it's really not been as daunting as, it may seem. So, just looking at those driver stocks and kind of what consumer confidence looks like as far as those go will really drive this market in 2023.
Looking forward, I guess, forecast now, kind of the second half of the discussion is, what do we expect in the mortgage market in 2023? What are the things we're looking at as mortgage professionals, and really trying to look ahead and plan for things that, one thing that's really interesting is the divergence of the Fed futures rate with the Federal Reserve's actual dot plot. The dot plot is what they use, kind of the dots on a graph, as to predicting the highest point of the Fed funds rate, which the dot plot is a little north of 5%, and the Fed funds futures is kind of right about 475, right in that range. So it's tightened up a little bit, but basically right now, we're at 4.5. So Fed saying they're going to give another 50 basis points. And the market's saying, you're bluffing a little bit. We're thinking maybe it's only a quarter. Certainly the last couple of weeks of the year, where you don't have a lot of bond traders at their desks, we've seen that divergence narrow a little bit. And of course, the Fed isn't going to diverge. So it's a futures market that's coming towards the Fed. The old saying, don't fight the Fed. You can fight it a little bit, but eventually everybody capitulates. And then the Fed eventually will kind of, reverse its course, as it always does. And then it's a free-for-all, right? So we're looking at that divergence, but really what's going to give the Fed any kind of cover to ease off their very hawkish stance is going to be what inflation does. So it's super simple for us. You look at the employment reports, you look at the inflation reports, the consumer price index, the personal consumption expenditure. Really, it's those three. Those are the superstars. And if they are trending downward, the Fed has a dual mandate: maximum employment and moderate inflation, which they've set at 2%. It's funny, they have actually said, hey, we need more people to lose jobs. So we're over maximum employment. How's that for, like we talk about forever, trying to create job opportunities? Well, we have our Federal Reserve that is literally saying we want to see people get laid off, which is sad in a way. But if that's what's necessary to kind of normalize the economy and costs, obviously wage pressure, wage inflation is huge. So, if those employment numbers come down and the consumer price index, the PCE, if those show closer to 2%, it's all going to change. And keep in mind that, a major part of the inflation really kicked in the early part of this year, 2022. So we're kind of going to be lapping over that again here shortly in early 2023. So kind of your year-over-year comparisons, you're comparing against what was already higher costs. So that inflation year-over-year number should really kind of, narrow. People have even talked about, by quarter 2 or quarter 3 next year, you might even see some deflation in some areas because of that year-over-year comparison, and with supply chains easing up. And again, if supply chains are normalizing, they talked about container ships in harbors, that's tremendously better than it used to be. There used to be, hundreds of ships waiting to dock. That's all gone. That's normalized. The cost of lumber, other inputs for construction are way, way down. So supply chain's catching up there. I think it's just the wage costs piece of it and the backlog contracts, that'll normalize as well too. So I really think that you got to, maybe on the long end, you get into Q2 of next year, man, and things are going to change. Unfortunately, I think that involves a number of months of having to deal with the slog that we're in right now. But there is light coming at the end of the tunnel. It's just how far away that tunnel opening is. I'm not sure yet, but I'm really hopeful for the back half of next year to really have some tremendous opportunities in the home lending world as rates come down, hopefully down back into the low fives.
It sounds like there's plenty to think about. I just wanted to wish both of you a very successful 2023, and I think we all can say adios, sayonara, and goodbye to 2022, and happily so. So thank you both gentlemen for joining me here, and we'll do this again.
All right, thanks, Mike. Happy New Year, everybody.
Thank you. Happy New Year.